Good evening, everyone, and welcome to Free Teach. Today we keep our run along our look at financial maths, and today we tackle the amortization tables. Amortization tables are these beautiful, or to some people, ugly things right here. All right, they basically tell you, in a nutshell, everything about the loan that you want to know. Okay, so you've got payment numbers, payment, interest, principal reduction, which we'll define in a minute, and the balance of the loan. All right, so they look like they've got lots going on. They're quite logical when we break it down, and so we'll get into it now. Okay, so a business borrows $10,000 at a rate of 8% per annum. The loan is to be repaid by making 4 quarterly payments of $2,626.20. The amortization is below that one there. And we want to firstly determine to the nearest cent the quarterly interest rate. Okay, so A is the quarterly interest rate. Hopefully, we can all see pretty quickly that the quarterly interest rate is going to be a quarter of the per annum interest rate. Okay, so quarterly R is going to be equal to R divided by 4. Okay, so R divided by 4, or 8 divided by 4, we get 2% as our quarterly interest rate. Part B, the interest paid when payment 1 is made using the quarterly interest rate. Okay, so it's asking us to find this part here. If 2% is the quarterly interest rate, then the interest we're going to pay is 2% of the previous balance. Okay, so interest is equal to 2% times the previous balance, which is $10,000. Okay, so that's how much money is owed. All right, we'll pop over here and .02 times 10,000, we get $200. So in here, I can put 200. Okay, so this interest column is equal to the interest rate multiplied by the previous balance. Okay, so our previous balance was 10,000, multiply that by the interest, that gives us the amount of interest paid. Okay. Part C. The principal repaid from payment 2. Okay, so this is this box here, principal paid. So the principal paid is known as the principal reduction. Okay, so the principal reduction is equal to the payment minus how much interest we had to pay for that period. So you can see that here we've got the payments 2626.20, so 2626.20 cents, and we're going to subtract the interest, so 151.48. So remember, this is a loan, so the bank's charged us $151.48. Okay, so the bank's charged us this much on our loan. Our payments are $262.20. So the amount that the the principal, which is the balance of the loan. Okay, so this is also known as the principal. So the amount that that's reduced by is our payment, take away how much the bank is charging us for that period. Okay. So put my black pen back on, head over to our calculator, 2,626 and 20, subtract 151 and 48 equals 2,474 and 72 cents. Okay, so that's our principal reduction. So we can put that in here, nice and small, 2,474, 20. Okay, so done. Tick, tick, tick. The balance of the loan after payment 3 has been made. Okay, the balance of the loan after payment 3. So, part D. Okay. The balance of the loan just here, that is equal to the previous balance. So we'll call this the current balance. So current balance is equal to the previous balance, so what we had owed last time, which is just here, previous balance, and take away the principal reduction. So if we look at both of those, previous balance 509,908, 509,908, take away the principal reduction 2524, 2524 and 22 cents, and that will give us our balance of the loan. Okay, head over to our calculator, clear that off. 5099.08, take away 2524.22. Be better if it was 23, wouldn't it? 25, 24, 23. Anyway, just a pattern. So our answer, better hit equals, is $2,574.86. Okay, so that's part D. So current balance over here is 2,574 and 86 cents. Okay, getting a bit hard to squeeze it all in. So part D is done. Part E, the total cost of repaying the loan. All right, now the total cost of repaying the loan is, hopefully we're going to skip past that it's $10,000, because it's definitely not $10,000. The total cost to us in repaying the loan is going to be the principal plus the interest. Okay, so the principal of the loan was $10,000. The interest, total interest, which I'm going to have to add up, is 200 plus 151.48 plus 101.98 plus 51.50. Tally that, and we get 504.96. So that's our interest there, 504.96. So add those two together and we get $10,504.96. All rounding very nicely. Last part, verify that the total amount of interest paid equals the total cost of the loan minus the principal. Okay, so verify the total amount of interest paid. So we want to make sure that there is equal to the cost of the loan, this section, minus the principal. Okay, so scroll down a touch here. Okay, so total cost equal to sorry, total interest, that should be equal to the total cost subtract principal. Okay, and based on how we've worked that out there, we should say that that's going to be obviously correct. Total cost of loan, $10,504.96. Take away 10,000. Couple extra zeros might help, and we get 504.96. Okay, so hopefully that helps out with the big curly things that are amortization tables. If you can see or start to see how each section is linked, you can see that many combinations of questions can be asked here. They can put blank spaces in lots of different spaces. Is a relatively simple one, but just think about what's missing. And even over here, if we think about potentially, so principal reduction, if we knew that the principal reduction was a certain amount and we knew what the interest paid was, we'd be able to work out what the payment is, all right, just by performing some algebra, adding the interest to the other side. Okay, so there are lots of little variations in these questions. So if you have any questions, comments, throw them in the comments, or hit like, subscribe, thumbs up, all those things, share it with your friends, and hopefully you are getting through this period well. Good luck. Good night.